Hey, Austin, this is Bill. Sorry to get back to you earlier. Let's take a look at what we got here. I sent you over some of the listings of the multifamily and just kind of wanted to kind of show you how this works. So basically, that duplex listed at 475. I think they did a $25,000 price drop. It was 500 grand. Rents on that would go for about 1650 to 17, 1800, something like that. Probably 1650 would be a safe bet. So this is a low rate 6.375, a mid rate 6.625, and then the low cost 6.875. How this works is the if you look at the closing costs and you look at the points, you're going to pay 6.375. You're going to pay 1 point basically at 4512 in points, 4,500 or 4512 points. This is 1786 in points. This is going to be basically no points here. And so a higher rate means a higher payment. And so then we look at the payment breakdown and we say, okay, if this payment that we're going to be paying $4,500 for, but we're going 3264, this payment of 3338 we're paying 1786 for, and then this payment of 3413 we're not paying anything for it. So we take a look at the variables between here, and here, and that is these right here. So this is the highest monthly payment. You save $75 here and $149 here. So what we do is say, okay, if let's say I'm saving $149 versus this 6.875, but it's costing me, remember that's costing me 20 or $4,512. So we say, okay, if I'm making $149, but it's costing me that $4,500 to save $4,500 to save $149. How long does it take before my break even point occurs? Right. So this is the comparables between those two. So then we say, where am I going to be at in 24 months? Is down here. So in 24 months, you would be better off doing the 6.625. Every single month after 24, it starts looking better here. If this was shortened to like 12 months, you're going to be better off doing the low cost. And we're going to go over this multiple times as we kind of do, go get into the business together. But I typically know that, I mean, in my mind, rates are going to be dropping. What I like to see is more like less out of pocket. But in a case like this, you're either going to come in with 32,364. I believe you said you had about 30,000 in savings, 34,000 or 36,000. That's going to cover your taxes for a year, your property insurance, let's say we close when I'm looking at here and I'm looking at closing costs. Let's say, so here's your APR cost, which is stuff like an underwriting fee and title and those kind of things. Your non-APR costs are here, which is like an appraisal, things that you can hold in your hand are non-APR costs. Your prepaids are going to be a year of homeowners insurance, which runs I'm thinking about $1,200 a year plus 3 months reserves. Then you're going to be running. We're going to collect if we close this. Let's say we closed in the month of November. You're going to skip December for a payment. Your first payment is due in January, so it's January, February, March, April. 4 months of taxes. We're going to put in 4 months of taxes into the reserve account. So that's what the prepaids are about: taxes, insurance, and then if we close on the 15th, 15 days of interest in November, you're going to skip December for a payment. First payment is due in January. So this looks pretty good as far as 475 would get you your down payment. Put 5% into this home, live in it for a while, end up moving out and buying a new one in 6 months or so down the road, and get it cleaned up and nice and everything. I'm also going to send you a link in this email to this specific house, and once I get your email, and we'll start seeing what we can do with you. All right, bud. Talk to you soon.